You're watching Stock Watch this week. I'm Ndawling Lechela, and joining me to unpack your stock-related questions today via Zoom is Victor Seanie from Benguela Global Fund Managers and Ricus Reeders from PSG Hole in Ruimsig. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag Stockwatch. Gents, thanks so much for your time this afternoon. And let's start off maybe reflecting on markets action this week. We are ending the week off on a rather calm note after Trump announced a ceasefire agreement between Israel and Iran earlier this week. We saw the S&P 500 and NASDAQ also hit their third straight record high yesterday. Just your reflections on the week that was, Victor.
So it was a very topsy-turvy week, a lot of action happening, kicking us off at the start of the week with the announcement of the truce. So it was initially a little bit of a fragile truce, but the rest of the week, markets became a whole lot calmer. So this reminds me a little bit about the situation back in 1990 when you had the Gulf crisis. Where Iraq invaded Kuwait. You had an extreme spike in the oil price for about 3 months, and then the following 5 months, the oil price reduced back to the levels it had been trading at the year before. So as soon as the situation appears to have stabilized, which Trump is really a big proponent of, you see that markets calm down, the oil price retreated, gave back most of its gains. And the situation is a whole lot more optimistic. So a positive outcome on the geopolitical front, but we also saw that in the US, stocks have rallied again. Record highs have been achieved by the likes of Nvidia, becoming the most valuable company again, and so on. So there's calm in the market at the moment, but the situation is by no means fully resolved.
And there's actually a question on Nvidia, but we'll get into that in a bit. Ricus, the Fed was also under the spotlight today. While we were watching Fed Chair Powell in front of Congress, there were also reports of the future of the Fed saying that, or rather the Trump administration saying that, or reports, yes, it was reports, saying that Powell's successor could be announced as soon as September. We saw the dollar faltering. Has this been something that's been on your radar?
Yeah, I think since Trump opened his mouth and he's basically instituting a shadow Federal Reserve chairman, I would imagine the general market opinion is that whomever takes over from Powell will have a far more accommodative stance towards Trump's policy for the next 3 years.
Yeah.
As far as interest rates are concerned, and that should lead to dollar weakness and or continued dollar weakness, shall I rather say, rather than the independence that we've grown used to over the past decades.
All right. There's been a lot of movements in the defense stocks this week, particularly those European counters. Yes, on the back of the geopolitical tensions. And in addition to that, we saw NATO nations confirming or affirming their priorities to defense spending, committing about 5% of GDP to that. A viewer asking whether you find counters in that sector attractive. I'll start with you, Victor.
Yes, there are a whole lot of counters that are attractive. Unfortunately, many of them have rallied tremendously ever since Trump convinced NATO to increase their spend. However, there is still a whole lot of runway for these companies because at the moment, NATO's spend on GDP, spend on defense as a percentage of GDP hovers just slightly below 2%. And we know that they want to push that to 5%. Names in defense that have not rallied as hard as the European names, such as Rheinmetall and Ring and so on, are the U.S. defense names, but they have not rallied as much as the European ones. So there may be opportunity there because the European players may tap into the technology that the U.S. companies have. Rank, for one, Rank was listed in the post-COVID period. So as a small company, it may still have a lot of legs to grow further from this point.
All right. And what about Palantir, Ricus? As you know, it's emerged. I feel like it's emerged as a fave for a lot of analysts here on Stockwatch. It provides, AI systems to the U.S. Army.
Yeah, it's probably the most immoral company that I can think of, and also, unfortunately, one of the most attractive as they spread their web of spying, to call it bluntly,
Yeah.
into for both the U.S. government. In other words, they've got a sponsor in that effect, and we all know the U.S. government has got very, very deep pockets, so that's a nice backstop to have. And yeah, and the access that they are gaining to the private individual is amazing. So in that sense, the future prospects is great for the company, maybe not so great for the private individual's privacy. But just looking at it logically, as far as electronic security systems are concerned, it's an obvious choice.
All right. And we've also seen a counter like Sirius betting on increased defense spending. Just yesterday, the group said it purchased a light industrial property, which is home to a key NATO base. Is that perhaps another way to sort of enter that sector, Victor?
Yes. So I think whenever you're looking at a company that offers a certain service or product, you'd want to be sure that this product that might lead to tremendous growth represents a meaningful percentage of the company's overall profits and revenue. So if it's the addition of a single asset, such as in the case of Sirius, that may not be enough to move the needle overall for the business. But definitely a heads-up play, a shrewdly timed purchase by Sirius's management. So that should bode well for Sirius's distributable earnings in the future.
All right, let's shift focus to the tech sector and a question on Nvidia. The viewer just asking what was behind the rally. We touched on it at the top. I think it hit an all-time high this week, Ricus. Is it just the positive sentiment?
No, I think the factor that drove the company-specific share price higher was the announcement of a structured disposal of shares by the CEO.
Okay.
We knew he had to sell, but now we know how he's going to sell. So that overhang, or the possible overhang, has been defined more clearly. And in conjunction with the rest of that sector, I think Nvidia just got that extra boost.
And the positive sentiment out from Nvidia also filtered through to counters like TSMC. Is that something you're looking at, Victor?
Yes, TSMC is a stock that we are overweight in our portfolios. We feel it's one of the most defensible businesses within the semiconductor space, given its dominant scale, more than 62% market share in chips, and particularly in the most advanced chips. So very, very strong position there. Perhaps the other player that does have a strong position is ASML, whereas the fabless players may be subject to a lot more competition. But it's difficult to see how TSMC's position can be challenged, not only from their scale, but also from their proprietary technology that offers significant entry barriers.
All right, let's shift focus to the mining sector. Question here. Is South 32 not overlooked? I mean, it is in copper and aluminium. Have you seen how aluminium prices are moving, trading below value of 38 rand? Not sure if that's true. Ricus?
Yeah, it's well diversified. Obviously, the Trump sanctions on various resources has impacted the share price over the past few months, but that whole sector in general, whether it be BHP Billiton, Anglo American, Glencore, certainly over the past 2 or 3 days, have seen quite a bit of interest from the market, not only locally but also globally. Not quite sure what is driving that because I can't really see any immediate growth effects as far as the global economy is concerned, driving those prices. But maybe it's just a question of having been oversold over the past 6-7 months.
And are you seeing opportunity in South 32, Victor?
South 32, I think, yes, to the extent that the stock is depressed because of low commodity prices.
Yeah.
This is usually the best time in the commodity cycle to get into commodity miners. Concerns, though, about South 32 is its historical returns on invested capital and capital allocation by management. So the interest will be muted. If a position were to be taken, it would be a very modest position in South 32.
And just sticking with miners, we've seen a slight decline in the gold price as risk is on. Does this present perhaps an opportunity to get into some of those gold counters that have been running, Ricus?
Well, gold's at a 4-week low, so that tells you how the gold shares have been doing. I think they're getting back to viable levels. The outlook for the metal itself, despite the rally we've had, is still quite positive. And not because retail is buying into it, but there's still a huge allocation by central banks to gold. And while that continues, gold has got the wind from the back. So certainly on any further weakness in gold shares, they'll become attractive again.
And any counter you're liking from the local gold miners? Any company you're looking at in particular, Victor?
Yes, when it comes to the miners, we typically favor the ones that have the lowest cost per unit of gold ounce produced. We did see that in 2024, Harmony, which had traditionally had the highest cost among the big three South African gold miners, they actually improved their cost position significantly, which contributed to its superior price rise over the past number of months and years. However, that was a little bit of an abnormality. They do guide that their costs will increase and take them beyond Goldfields and Anglo Gold Ashanti again. So the gold counter that we favor is a Goldfields because of its cost position relative to the other two. Not as low as global gold miners such as Barrick and Newmont and so on, but Goldfields would be the one in South Africa that we favor.
A viewer asking for your analysis on H&M and Inditex. Quite a competitive market, of course, with the likes of Shein dominating fast fashion. Also, those tariff risks could see those companies increase prices as well. Your analysis on that, Victor?
Yeah, so Inditex versus H&M. I favor Inditex, the owner of Zara, over Inditex because Zara and Inditex has been a lot more successful at managing the key risk in the fashion retail business, which is fashion risk. They've done that consistently over the decades. If you look at their operating margins, which have been tremendously consistent over the long term, they've done very well to transition from store-based exclusively to the digital realm. And unfortunately, on the H&M side, they are a lot more exposed to lower price competitors such as Shein. Zara plays at a higher price point, so they do not compete head on as much with Shein as much as H&M does. So that's H&M's difficulty. It is not the dominant player within its segment of the fashion retail space. And historically, its execution on fashion and managing fashion risk has been far less impressive than Zara, for instance. So I see H&M is trading at depressed levels. However, the quality player, Zara or Inditex, is the one that has come down from its peak share price, but it is the one that I would put my money in for a safer long-term hold.
All right, let's bring it back. Yes. No, you can continue.
Sorry, last word. HMN is more of a cyclical play.
Okay, so then let's bring it back home then, Ricus, and I'll ask you about the local clothing retailers. We've seen really good numbers out from TFG, Mr. Price, as well as Pepco. Are you seeing value there?
Yeah, they've come back. I think we've had quite markdowns in some of those retailers, Mr. Price, for Seanies, and they seem to have stabilized a bit, but my preferred counter there is still Pepco Holdings, which has held up very well in comparison with the others, and I think will do so. And not so much because of their clothing exposure, but the move into financials, whether it be smartphones or insurance. I think there's great runway for them in those directions. So preferred counter Pepco, and I think it's a hold and possibly a buy at current levels.
All right. And then, Victor, there's a question here on Nike, and the viewer asking if you prefer Nike over Adidas.
I own 36 pairs of Jordans made by Nike and about zero pairs of Adidas.
So you're biased. You're biased at this point.
I think if you look at the long-term track record of the two companies, Nike has been far superior. Sometimes a great company meets a not so great manager, and that's what happened to Nike in the early 2020s. They hired a non-shoe person, I'll call him a non-shoe dog, to run the company. Unfortunately, he made a couple of very poor strategic decisions in shifting the business. So Nike is now trying to fix about 4 years worth of mistakes, positioning into lifestyle as opposed to being focused on Nike's heart and soul, which is focused on sports and great athletes. So Nike's a turnaround. I strongly believe a great factor in this turnaround is that Nike's balance sheet is still really strong.
Okay.
I think they'll be able to emerge after a lot of pain, cleaning out the inventory on their balance sheet. After a little bit of pain, they should be able to turn the business around. This is Nike's very first big stumble in the company's 50-year history. In comparison, Adidas has had numerous stumbles over its maybe 100-year history. So at the moment, Adidas is still flying high because of its terrace shoes, which you may be wearing at the moment. But I would go with Nike because on valuation basis, it's a whole lot more attractive than Adidas.
All right, so we're taking your view with a pinch of salt because you do own over 50 Jordans. Ricus, anything to add on that front?
I know nothing about fashion, as my friends would attest when I go out. So I'll totally and absolutely rely on Victor's extensive knowledge as a fashion god, obviously.
All right, let's bring it back home. Looking at the telcos counters, a question here on the rally we've seen in that industry, and the viewer just wanting to know what's been fueling the upward trend there. I'll give that to you, Ricus.
It's diverse, I think. Telecom being in a turnaround situation. MTN also starting to get better results out of their Nigerian and other non-local investments. But that sector as a whole has been flying. I think if it's certainly in the industrial space, the best performing sector over the past 6-12 months. With just technically looking at graphs and things like that, with more upside built into it for some or other reason. But as I said, it really is companies specific. And I forgot to mention Bluetail, which has had an amazing run, and that's also on the back of restructuring of operations and some financial engineering.
Would you be nibbling on any of those counters, Victor? Telkom looking cheap, I guess also just providing a cheaper way into the industry?
Yeah, I'll probably be more positive on Telkom than the rest of the players. Telkom is doing really well at growing its mobile services business. In South Africa in particular, whereas MTN and Vodacom are both growing their South African revenue at least by only 1 or 2%. It's a very difficult business to grow in. MTN is very cyclical because of its exposure to the Nigerian naira. So yes, the best time to buy MTN usually is immediately after there's been a big devaluation, i.e. that would signal the bottom of the cycle in Nigeria. I think MTN now is approaching fair value. It's had a good run, but I think it's approaching fair value. Vodacom is a very strong operator. I think it has good room to run still. It's got Kenya in its portfolio, so my picks in order may be Telkom, Vodacom, then MTN.
Okay. All right, then a question here on your take on Newton and Purple Group, Ricus.
Purple Group is interesting. There's certainly a great narrative behind it as they gain market share, extend not only the scope of their current operations, but branch into other areas. It's still very much a growth story than a results story. Although I mean, one can't fault their results, but there's a lot baked into the price. But as a speculative investment, so far so good. So I have some in my own personal portfolio. I'd be hesitant to recommend it for the conservative investor, if I can put it like that. But as an interesting aside, it's certainly becoming more interesting by the month or by the year.
And Purple Group?
That was Purple Group.
That was Purple Group.
That's right. Yeah, sorry about that. And the other one you were asking about,
Newton and Purple Group.
Oh, Newton.
Yes.
Oh, yeah, that's mental block against that one. Look, they're on a turnaround situation, and the last sets of results showed an improvement, but they've got to keep on improving and making money basically. And if they don't do that, they've got a debt problem. So I think it's a little bit early days for me on that one.
Okay, I'll give you another question, Victor. Your view on Hudeco at these levels as a long-term investment?
Hudeco is a very well-run company, conservative management. It still has room to run, being a medium-sized business. A decent balance sheet. It's trading at a P of about 11 times and a dividend yield of 5%. So it looks somewhat attractive. The share has had a strong run. So yeah, I would conservatively step into it. I wouldn't put a big chunk in the portfolio, given that the price is somewhat elevated, but a really good business to hold for the long term.
All right, let's get into your stock picks, starting with you, Victor. Where are you seeing opportunity at the moment?
So stock pick for me is a US-based restaurant company. I'm feeling kind of hungry, so I'll talk about a food business. You may have heard of Chipotle in the US. So Cava is a fast casual restaurant business in the US. It's small. The cuisine that it serves is the Mediterranean cuisine. And the Mediterranean diet is the most recommended diet by dietitians. What's attractive about Cava is not only does it have a great product, its in-restaurant service model is similar to Chipotle's, the assembly line model. Its food is very tasty. I know of Americans who drive 20 minutes to a Cava when there's a Chipotle just 5 minutes away. So attraction in financial terms, it's got a long growth runway. At the moment, it only has about 370 odd restaurants. That's 10 times fewer than Chipotle has. And its goal is to get to 1,000 restaurants by 2032. So that's about a compound annual growth rate, about 15% over the next 7 years or so. So nice growth runway. On profitability, its restaurant level margins are between 23 and 25%, approaching Chipotle's level. So attractive economics, revenue per restaurant, as well as just 10% below that of Chipotle. So the balance sheet also is strong. It's sitting at $300 million of net cash. So it's a good growth story, good management. It listed about a year or two ago in the US. So it's an interesting one to watch. However, they always say beware. There's always execution risk. Beware the next something. While I say maybe the next Chipotle, those things don't always turn out that
Yeah.
way. But it's a very interesting stock.
All right. And then what about you, Ricus? Where are you hanging your hat today?
There's a company that we spoke about a little bit earlier, Sirius Real
Ah,
Estate. Not because you spoke of it earlier. I was looking at GrowthPoint's results, where GrowthPoint is busy doing a lot of reorganizing, getting rid of suboptimal properties and trying to increase spend otherwise, you know, in other places. And I was thinking, why now? I mean, if you guys should have seen this coming. And it made me thought of Sirius, which is an extraordinarily well-managed property company, mainly focused in Germany, where they continuously evaluate opportunities, upgrade in conjunction with whomever's occupying those buildings, which is mainly concentrated in the industrial space, upgrading them, selling them, looking for opportunity and disposal. It's an actively managed property company that's with an outstanding track record in, unfortunately, a very low growth area, which is Europe and Germany. What has changed is, as we mentioned, defense spending increasing in Germany in particular. Now, when I hear that, I normally, when I hear Germany is increasing defense spending, I normally get quite nervous about that. But be that as it may, it should have a huge effect on the German economy, and specifically Syria's, with their concentration in industrial properties and their good management track record. I don't think it's necessarily cheap at current prices, but considering that their growth environment is about to change, they are very well positioned to partake in that growth.
all right, gents, let's leave it there. Thanks so much for joining me this afternoon. That was Victor Seanie from Benguela Global Fund Managers and Ricus Reeders from PSG Hole in One Ruimsig. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.